This property made £200,000 tax-free. Let me explain how.
My business partner bought that property in 2009 for £250,000 and he bought that in his personal name. I'll explain in a second why you might not want to do that because it might not make sense anymore. In 2009, he bought it for $250,000 and he got a 75% loan to value mortgage, which was £187,000. But let's just say this mortgage was with HSBC Bank. Now, 10 years later in 2019, that property had appreciated and it was revalued at £500,000. At that stage, he refinanced the property, which just means that he got a new mortgage on that property. And so the new bank gave him 75% of the £500,000 valuation, which came to £375,000. So imagine the original mortgage was with HSBC. Now this mortgage is with, let's say, Barclays Bank. Barclays Bank has given him £375,000. He's taken the 375. He's paid off the £187,000 from HSBC. So that leaves him with the remaining amount, which is the difference between this and this. So 375 minus 187,500, which comes to £187,500. The remaining £187,000, that's gone to his bank account because everyone else has now been paid off. Because this £187,000 is a loan, there's no tax. You don't have to pay any tax when it comes to a loan. So this is not income you've made. Therefore, this £187,000 is completely tax-free. And that is how he made almost £200,000 tax-free simply by letting the property appreciate in value and then refinancing and taking that money out as a loan as opposed to income that he has generated.
Let me explain why that might be a bad idea. In 2019, we bought a flat in this building, which is pretty much across the road from the other one, which is also a 2-bedroom flat. But rather than buying this in our personal names, we bought this in a limited company because since 2009, a lot has changed when it comes to tax.
Now let's compare the two. So we have the first property, which my business partner bought in 2009, which was in his personal name. And we have the property which we bought in a limited company. So they're both in the same area, 2-bedroom properties in London Bridge, ex-council properties. The market rent for both is around £1,800 per month. And just to keep the number simple, let's just say they both have a monthly mortgage payment of £1,000 per month. The profit is this section here, which is £800. And here, £800. But because of the Section 24 tax changes which came in 2016, what the government said is if you own a property in your personal name, your mortgage interest, which is £1,000 here, your mortgage payments, you cannot consider them as a cost. And so therefore, your profit from a government point of view, your profit is not £800. They're saying your profit is the whole thing, the 1,800. You can take away some maintenance costs and those sort of things, but just to keep the number simple, in this case, your profit is £1,800, even though you're only making 800. Now, if you are a 20% rate taxpayer, you would pay 20% tax on the 1,800, which in this case comes to £360. However, if you're a high rate taxpayer, which a lot of people would get pushed into, if you're making £1,800 a month from this property, realistically, if you have a couple of properties, you'll end up being in a higher threshold. So if you paid 40% in tax, that comes to £720 per month in taxation if you own the property in your personal name. But now, if you own the property in a limited company, you can deduct your mortgage interest and your mortgage payments as a cost because in a limited company, you get taxed on your profit, not on the entire revenue that you've generated. In this case, your profit actually is only £800. The 19% corporation tax rate, that comes to around the 350 mark or something along those lines. You would be paying about half the tax compared to if you were a high rate taxpayer. Now, even this £350, I'll explain in a second how you can even get rid of that tax. So you end up paying pretty much nothing in tax.
Setting up a limited company might seem like a bit of a painful process, but in 6 minutes and for the cost of £12, Awesome, who's also the sponsor for this video, they'll set up your limited company, they'll get your bank account pre-approved, they will literally do everything for you to get your property business up and running. So click the link in the description below and you can sign up to Awesome, who can help set up your limited company.
So you still had the £350 to pay in tax from the cash flow that you made in a limited company. Let's say you take the £350 across the year, that's 350 multiplied by 12, that comes to 4,200. Now you can't do much with £4,200, but let's just say you had a few property, £20,000 profit from your limited company. If you spend that money and you essentially just upgrade your property, so you add value to your properties, when those properties then appreciate and then you simply just get a new lender in there and then you refinance those properties, the money you get back from the refinance, because that is a loan, the company does not have to pay any tax on that loan, since it's not money they've made, it's just money that they've borrowed. What's happening is you're buying properties, you're renting them out, you're making cash flow, you're using that cash flow to buy more properties or add value to your existing properties, you're letting them appreciate, and then you're just simply taking that money back out as a loan. So in that whole process, you don't end up paying any tax and you keep using that money to build your property portfolio. At some stage, you would have to pay tax. This is not a way of avoiding tax per se, but this is just a way of building your portfolio very quickly in a very tax efficient way. So for example, let's say you do this and you built up a big portfolio portfolio. If that portfolio is now making a lot of money, if you want to then pay yourself a salary or a dividend, you then still have to pay tax in order to pay yourself. That tax you can't really avoid, but at least you get there much faster, as opposed to being in the personal situation where you might not be making any money at all. If your rent is 1,800 and 1,000 is your mortgage and 720 pounds is your tax, that leaves 80 pounds. You still have maintenance, management fees, those sort of things. So in personal, you might be in a situation where you're actually not making any money at all, as opposed to a limited company where you're making money and you're using that money to build your portfolio even quicker. So just by setting up a limited company, you can make a lot more cash flow and you can build your portfolio in a very tax efficient way, and it only costs you £12 to get started.